crypto is not just an asset class, it's an infrastructure for all asset classes. The strongest network effect that you could ever have is around money. And I think over the last 10, 15 years, looking at how tech has evolved I think it's proven without a doubt. If you look at where application revenue has been the highest across the entire industry in 2025, year to date, that is Solana.
What would determine, for example, if Bitcoin hits 200,000 versus coming down back towards 50,000?
I think
our guest today is Lily Liu, president of the Solana Foundation. With Solana potentially days away from an SEC approval for a spot ETF, institutional treasuries are now accumulating billions in SOL, and the network is processing more transactions than any other layer 1 blockchain to date. We're talking about the future of Solana and the future of blockchain technology and tokenization with our next guest. Lily, welcome to the show, Lily. Good to see you. Thanks for being here.
Thanks, David. Thanks for having me.
I want to start before talking about Solana itself. Let's talk about the broader crypto landscape and demand for cryptos right now. As we're speaking today on the 6th of October, Bitcoin is almost at $130,000, $125,000. It's come down a little bit from its highs, just new all-time highs week after week. What is driving this demand right now, Lily?
Sure. Well, the last couple of days aside, we've seen a huge run up in crypto this year, and I think it's probably for a couple of reasons. One is you've seen global warming around the world to this idea that this is digital gold. People really understand that, and now that the interest in Bitcoin has gone beyond sort of fringe retail buyers into institutions and even to governments, it's really accentuated this thesis of digital gold. There's only 21 million, never going to be more, probably only fewer as people misplace their keys and misplace their wallets. And that's been driving a pretty positive reflexive loop. And I think that one thing that's also really stimulated that starting earlier this year is the addition of digital asset treasury companies to the crypto ecosystem, and many of the early ones were specifically focused on accumulating Bitcoin. And essentially what digital asset companies do, or treasury companies do, is they accumulate the underlying token with the intent to continue holding it, and that will have a very clearly intended impact on supply and demand dynamics.
Do you feel like the motive for buying something like Bitcoin right now has changed from the last bull market, whereas maybe the last one was mostly retail driven? Right now, the race is to see who is accumulating more treasuries of Bitcoin. Is that kind of the narrative right now, or am I wrong?
Yeah, I think that Bitcoin, you remember even 10 years ago, Bitcoin was seen as not just a fringe, but potentially even a dirty or dangerous thing. And so unlike many other trends, it started really on the fringes, long tail sort of adoption of this asset. And then I think one of the milestone moments for Bitcoin was the introduction of IBIT and the Bitcoin ETF, which was about 2 years ago. And that really was a watershed moment, making Bitcoin more broadly accessible to the institutional audience. And of course, the potential buying size there in the institutional audience is huge, right? So step by step, that opened up the door for our smaller, broader base of holders to institutions. And now what you're seeing is sovereigns really starting to see Bitcoin as a must-have. And with that, the portfolio allocation over the last 10 years of how much should I allocate to crypto used to be less than 1% if you cross your fingers and if you hold your nose, to 1% to these days it's rating and investment banks report the other day, and now apparently they're guiding to 2 to 4%.
I just want to share with you this 50-second clip or 40-second clip from CNBC. Take a listen. We'll react together.
Now, this rally comes as the U.S. government officially shut down, a moment that has in the past boosted Bitcoin by shaking confidence in the dollar. Institutions have also been piling in, close to $2.3 billion in spot Bitcoin ETF inflows this week, adding fuel to the move. There was also bullish infrastructure news. The CME announcing plans for 24/7 Bitcoin and Ether futures trading by 2026. And Swift is working with 30 banks on a blockchain-based payments ledger built on Ethereum tech. Now, in terms of crypto-pegged equities, Coinbase logged its best week since June. Robinhood up almost 20% this week after CEO Vlad Tenev called tokenization a freight train that will eat the financial system. And I am keeping an eye on Bitcoin. It is within striking distance of a new all-time high, Scott.
Okay, so let's just comment on, well, several things. I'll let you comment on the whole clip, but particularly Vlad Tenev's comments, CEO from Robinhood, his comments quoted by CNBC towards the end, saying that tokenization is a freight train waiting to happen. I wonder how that's going to impact the whole crypto ecosystem and specifically Solana.
I think he's right. And it's going to impact crypto, but more than anything, I think it's going to impact traditional finance. What we see today is you have about $4 trillion worth of assets, which are crypto native assets. More than half of that is Bitcoin, and then much of the rest is layer ones, as well as a longer tail of different assets. Crypto as an asset class today is about $4 trillion. But if you compare that to traditional finance, which is, let's call it about $1 trillion, about $100 trillion, then what we're talking about is a huge base of assets that has the potential to be tokenized and brought on chain. And really, crypto is not just an asset class, it's an infrastructure for all asset classes. And it's only started with those crypto native tokens is the first thing to go to market, an asset class you cannot get anywhere else. But that's really just the beginning of what crypto as a technology platform is supposed to be bringing to future digital financial rails. And so I think is going to happen is the assets from traditional asset managers, from traditional financial institutions going to be tokenized. And the revenue opportunity for that for asset issuers is typically, let's call it something like 25 bips. And the attractiveness of crypto is that this is direct distribution for assets. The way that assets are distributed today is typically through sort of existing analog wealth manager relationships that have been built up over some part of the past century. Those are tried and true sort of wheel ruts in the rocks, and it works. But what no individual network, no matter how large, no matter how wholesale, can compete with today is the distribution of the internet, which is to 5.5 billion people that have access to the internet, therefore have access to basic cryptography, therefore have access to wallets, and therefore have access to the whole range of whatever assets have become tokens. And that can be anything between, at the most extreme, let's call it a money market fund, tokenized money market fund, many of those today. And then at the other extreme, meme coins, right? So the way we think about it is, I think about it as there being an asset spectrum. And I think one way to characterize that is, on one end, you have assets that have value but don't really command price. Let's call it a money market fund. And then at the very risky end, you've got assets that have a lot of price, but they have no value, the extreme version of that being a meme coin. And most of crypto is actually on that end of the spectrum, which is more about price momentum than it is about value. What tokenization is doing is they're starting at the other end of the spectrum and bringing assets on that are more about value than price. And once you start with money market funds, which everyone loves, finds useful, wants to hold, wants to buy, and that really includes a lot of people around the world that don't have access to US T-bills, and that's basically, the folks that are not living in the Europe or the US that don't have direct access through their brokerage account, if they can have a brokerage account, to T-bills. So I think that's the initial sort of pitch for why money market funds. And once an asset manager can tokenize a money market fund, then there is a whole range of different fund products that one can tokenize, recompose. What we oftentimes talk about in crypto is this idea of DeFi and composable finance, and the ability to sort of very quickly and flexibly build or on-chain structured products. So I think that's going to be a lot of the space of innovation that is going to come. We already see that coming as soon as we start to really run these tokenization engines.
Do you think crypto is still following Bitcoin, or are they diverging into different, or divesting, so to speak, into different narratives right now? Ethereum or Solana, where everything else moving on its own, versus Bitcoin?
I think there are two basic narratives in crypto from the very beginning. There is the asset purpose of blockchain, and then there's the infrastructure purpose of blockchain. The purpose of digital gold as an asset, I think, is now ready and apparent to most people who are observing the space. And I think that the other purpose of blockchain, look, it's really the title of the Bitcoin white paper, actually. It's a peer-to-peer electronic cash system. It's about creating financial infrastructure native to the internet that anyone on the internet can access. And so that is the infrastructure story, which everyone outside of Bitcoin is building. People will articulate it differently, but essentially you have Bitcoin, which is based on proof of work. And then you've got all of these other blockchains, which are competing to be some aspect of financial infrastructure for the internet. And that's all largely based on proof of stake architecture. So I think it really just comes down to, there's the asset, there's the infrastructure. We think about it as Bitcoin is the asset and Solana is the infrastructure.
So on that note, just finishing off on the macro aspect here, what would probably be the biggest determinants of price action for Bitcoin and hence the rest of crypto into the next year? So what would determine, for example, if Bitcoin hits 200,000 versus coming down back towards 50,000?
I think that right now the macro trends seem to support continued price appreciation for Bitcoin. What you see, what you have historically seen is that when rates drop, then alternative assets and higher risk assets seem to benefit from that. And there's no secret that the U.S. government, the executive branch at least, is highly interested in bringing rates down as soon as possible. So that is one tailwind, and it looks like the Fed is likely to comply with that. And it's really just a question of timing and time frame. So that's one. I think another one, as we saw in the clip from CNBC just now. Typically, Bitcoin has been a bit of a counter trade to sovereign stability. And when you see something like a government shutdown, people are also reminded of some of the original tenets of Bitcoin, which is this is state-free money, and this is something which is independent of what might result from governance discord, unbalanced governance, and its potential to create economic instability, both in monetary and also fiscal policy. So both of those would be momentum, would be things that would add momentum to, let's call it, Bitcoin trade. And on top of that, you've got the existing presence of Bitcoin ETFs. IBIT is the leader of that. You also have quite a variety of different DATs now. And I think there's now become, over the last 5 years, last couple of years in particular, quite a bit of interest in a product like an MSTR. So what I think we see being replicated across the crypto ecosystem more broadly is this pairing of, you've got an ETF, and you've also got a leveraged, some form of yielding equity asset as well, such as an MSTR that has broader, a little bit of a higher risk exposure. And those two products are things that are starting to appeal to an ever greater part of the investor audience.
There's this trend happening right now on the internet. People have been talking about the 4-year cycle being broken. This is Mike Novogratz, CEO of Galaxy Digital. That went on media saying that perhaps the new regulatory changes, specifically citing the stablecoin Genius Act and the Clarity Act, these acts that are being or have been signed, those will break the 4-year cycle, he said. He noted in the past the market followed a predictable pattern, primarily influenced by Bitcoin having cycles every 4 years, having events every 4 years rather. However, with new legislation in place, he believes the market may no longer adhere to this cycle. With those two bookends of legislation, it's going to unleash a tremendous amount of new participation in crypto. I think this goes back to what you were saying earlier about the two different use cases of blockchain.
Yes.
And so yeah, I'll let you comment.
Yeah, I would broadly agree that there are a broader set of catalysts today than maybe 4 years ago or 10 years ago with regard to the impact of regulatory changes on the crypto ecosystem. I think that those changes, those regulatory tailwinds, are going to accrue more to the infrastructure-oriented blockchains than Bitcoin as the asset. And the reason why I would think that is because as you see more and more adoption of stablecoin usage, trading use cases on chain, tokenization, and really there just being this flowering of utility, both in terms of asset availability as well as use case breadth on chain, then more and more people are going to be using these blockchains. And the way that these proof of stake, sort of the infrastructure blockchains actually accrue value is through usage. And so much in the way we saw with the internet, right? People would track usage for a while and see how app downloads, users, MAUs, DAUs would translate into value creation. The way that mechanism here works in blockchain is such that usage generates some combination of a base transaction fee as well as a priority transaction fee. Those fees accrue to validators, and validators share some portion of that, in some cases, much of that, with stakers. Stakers are, of course, holders that choose to stake their tokens with a validator. So that is a mechanism through which usage and adoption results in value capture that accrues to both validators and stakers. I think it's a really important point to make because I think the value creation model of the asset, that one is a reflexive Lindy asset with a fixed supply, underwritten by the cost of proof of work mining. Right, that is the let's call it for lack of a better word, the business model of Bitcoin, the asset, store value assets. But then the business model of infrastructure chains is fundamentally different. And that is how you draw the loop between usage and value creation and value capture.
All right. Going back to Solana now, I mentioned in the beginning that we're potentially days, if not weeks ahead, we're before an ETF approval for Solana by the SEC, and a lot of funds and companies are in the process of launching Solana ETFs. What would that change for Solana, if anything?
Sure. I think that what we see now is we see this pairing. If you take Bitcoin as an example, you see this pairing of there being an available ETF, which has seen quite a bit of demand, and then also with a variety of different Bitcoin DATs. And having this pairing of different products available to the traditional finance world and riding on the distribution rails of equities, which is quite broad, and a very deep market, is something that is quite beneficial for the various crypto ecosystems that are represented in that pairing of products. So I think that it starts to build out some diversity in sort of equity-based financial products for folks that want to get exposure, and that means that there's potentially a broader set of ways to appeal to prospective investors, depending on what they're looking for.
What is the next major milestone for Solana that we can look forward to? Let's start there.
Sure. I think there's several. I typically think about an ecosystem in sort of three component parts. One is around the network layer. That's the actual core protocol itself. And that's a foundation for everything, of course. There's also the app layer, and that's where builders are building unique applications only possible on Web3. And then there's also the asset layer. We talked a lot about tokenization, a lot of assets coming on chain. So if I start with the network layer, I think what we're super excited about is, look, we're always tech first. Nothing happens without unique technology. We're always pushing the boundaries of, as one of our co-founders, Anatoly, likes to put it, pushing the boundaries of physics. And so there we've got a huge network upgrade anticipated in about a year or so called Alpenglow, and that is going to make the network ever faster, ever cheaper. We're already the fastest and cheapest, the most used, more used than all of the other chains combined by a multiple. And right now, if we're at around 400 milliseconds, this is going to bring block times down to about 150 milliseconds, and that's really powerful, while also maintaining decentralization and one of the highest Nakamoto coefficients in this industry. So that's very, very powerful. And what that's going to unlock is, already we've always had this vision that you have one single layer for all financial markets, interoperability, composability. You don't have to go through interop between different chains because you're already in the same execution environment. And the way to maintain that and really make that globally scalable is to continue to increase bandwidth. We talked about increasing bandwidth and reducing latency. So there's a lot of cool stuff happening at the network engineering layer that is opaque to some folks, but that is really the foundation of what we do. And then I think with the app layer, some of the things that we're really excited about is leveraging that differentiated technology at the network layer to build really unique trading systems on chain. And so what you're going to see later this year is you're going to be seeing, people are talking about perps dexes these days. There are 10 different ways to architect a perps dex. So you can call it all perps dex, but they're not all created equal. And one of the things that we're working on as the Solana ecosystem is really innovating at the bleeding edge of trading microstructure in ways that are suitable for decentralized finance, where the one thing you cannot control in DeFi is to have co-located servers as you do in traditional finance. So keep an eye out the end of the year for some pretty cutting edge trading applications and trading architecture that I think is going to be pretty unmatched in the industry. And then on the asset side, we're super focused on stablecoins and RWA issuance. Our vision there is to really become the default settlement standard for this industry. When people think about moving money, they obviously want to do that as quickly and as cheaply as possible, where there's also depth and liquidity. And if you just look at that handful of things, then there's nowhere better than using Solana. So that's one thing that really focused on as well.
People have been commenting on when Solana is going to get to the level of Web 2 throughput. Visa, for example, at peak capacity processes up to 65,000 transactions per second. And The question is whether or not Solana can get there. Technically speaking, what would be the bottleneck to preventing that from getting there immediately?
Sure.
Yeah.
Sure. So some of the network upgrades that I talked about, Alpenglow, that should be out in about a year and a half. That's really going to elevate performance to be at that throughput as, for example, a Visa. Visa is also a partner of ours, and we've worked a lot with Visa in the past. And they're also excited about what we're doing on that front. And I think that when you look at Web 2 throughput and Web 1 throughput, what you experience as a consumer is not actually the reality of how money moves efficiently, or I should say not efficiently at all, in the background. So what you already see with quite a number of B2B payments processors, for example, is a deep interest in using stablecoins because the ability to move money truly 24/7, 365 within a fraction of a second for a fraction of a cent is just something you cannot do anywhere, even if it seems like that in a web interface.
So we're seeing tokenization happen, like I mentioned earlier, on a really rapid scale. It's growing fast. Tokenized treasuries, real-world assets is growing fast on Polygon and Ethereum. Also, lots of projects launching on Solana as well, financial products, that is. Why should an institution choose Solana as a base layer?
I think that, so first of all, I think the best assets are going to want to be everywhere. And I think that is different from in the past when we were looking at application builders. An application builder should not want their backend to be everywhere. And so I think that we need to think about builders, innovators, entrepreneurs differently from asset issuers. That's a bit of a separate point. But then I think that the reason why institutions consistently decide to build on Solana, oftentimes what we've seen them do is they huddle and study for a year, sometimes longer than a year, all the different various blockchains. And many times they've come out and said, okay, Solana is really the only one that we think is the long-term partner for us. Why is that? Because first of all, the simple things, it's fast and it's cheap. It is a unified environment. And one of the first order requirements of financial markets is to have unified liquidity. You want to have as deep financial markets as you ever possibly can. That is a first feature requirement of building technology for finance. And really nowhere else across the industry do you have that perspective from day one that you need to build a single execution environment that can unify liquidity, one, and also accompanied by the performance to be able to enable that over time, as well as the breadth and depth of different assets. So our perspective has always been that blockchains fundamentally are about technology for finance. And you've got to build that technology platform to maximally serve financial markets. And that definition is actually quite a broad one. That is the whole range of different assets from, so we were talking about earlier, money market funds, all the way to high risk crypto native assets. And then also you've got to build a platform that can unify the whole range of use cases for how people might want to use their money. Everything between moving money, let's call that a payment in its B2B, B2C, C2C forms. And then on the other extreme, highly leveraged, high frequency trading types of applications. What we've seen with content on the internet is the utility people get when they're able to access all of their content through single rails, right? We all use the same internet infrastructure with infinite numbers of applications, but you essentially have one infrastructure portal into that world of content. And we've experienced how that sort of explosion of content and the ready access to it has been very powerful. No longer are you going to one portal for books, another for newspapers, another for TV. It's all now just data that is accessible at your fingertips. And so I think that is an appropriate analogy to draw to what blockchain does for financial markets. It takes all of the assets and all the ways to use those assets and puts them into a single environment. So you open your wallet. Anyone who has access to an internet connection, which is about 5.5 billion people today, in your wallet, you can hold simultaneously a money market fund, a meme coin, a US dollar stable coin, a non-US dollar stable coin, wrapped Bitcoin, you choose. And that is the broadest potential financial access that I think one will have about 5 years from now, if not sooner.
Do you think that going forward, real world assets will be more dominant for use cases on Solana in particular than, let's say, DeFi itself?
I think that RWAs, real world assets, and DeFi, these are complements to one another. DeFi is the range of use cases through which you can put your assets to work, and RWAs are some subset of the $100 trillion of traditional finance assets. So I think that these are necessary to actually really work together. And what we already see happening on DeFi today is people are taking their RWA, putting it into lend, borrow, credit markets on chain in DeFi, and using that as a way to leverage their yield off of their tokenized, for example, private credit fund. And that is a use case around a let's call it a traditional finance asset that you cannot do in even the most sophisticated financial markets in the world today unless you are a very large wealth client. So what you can now do is you can take a tokenized, let's call it private credit fund, you can deposit that into a lend, borrow dollars against that, and first of all, you can just do a single collateralization, and that introduces collateral value, instant collateral value to practically any asset that you might have in your wallet. So that's something which is very unique that only DeFi can add to the world of RWAs. And for folks that are looking to trade off a bit of risk and yield, then what you can do is you can borrow, let's call it dollar stablecoins against your RWA, loop that back and forth. And what you see people doing today is in certain cases and in certain market conditions, being able to get 30+% yield off of stablecoins. So, certainly there's a range of risk appetite in there that is going to be appropriate for some and not others. But that introduces now a whole sort of new range of access to ways to use your assets that you can really only do on DeFi.
One of the other developments that we've seen in the past is GameFi. It's not really active now. It was very popular in 2021, but now there's rumors that that one of the most popular franchises, Grand Theft Auto GTA, may be using crypto payment systems for GTA 6, which is scheduled to be launched next year. This is still a rumor. We don't know if they're going to develop their own in-house token or they're going to accept crypto as payments for in-world purchases. But if this were to happen, this would be the first major and perhaps the biggest game ever to be involved in the GameFi space. Is there a future for Solana in GameFi?
I'm not specifically knowledgeable about GameFi, but I can comment on the use of stablecoin payments in a whole variety of different applications. And I think this is, for folks who remember a few years ago, there was a big narrative cycle around gaming. And one of the most sustainable reasons that blockchain is useful to gaming is actually really about on and off ramping value into and out of games. And so I think that this example sort of highlights that. And the reason why that is interesting for online games is because oftentimes their player base is inherently online and therefore around the world, holding any variety of different currencies. And one common denominator for many of those players potentially is access to stablecoins. And easy to implement the API, there you are, send and receive almost instantly. And that's quite powerful. So I think that what we're going to see is stablecoin payments integrations into practically every online experience. And some of those are going to be supporting very consumer in nature experiences. I think it's going to be a little bit longer before that happens. But what we're seeing being adopted at speed right now is B2B cross-border money movement use cases where both sort of B2B sides of that understand the value of being able to move money practically free, practically instantly, as long as the internet is on.
Currently, Solana validators earn rewards through inflationary issuances of Solana. I think the question here from some people in the Solana community is, how do we maintain a sustainable business model going forward such that validators are rewarded, but we don't have heavy token inflation? How would you respond to that?
Right. So inflation is already programmatically decreasing about 15% every year, or exactly 15% every year. So there is a programmatic decrease in inflation that has been in place since 2020. Inflation actually used to be much higher. There were times when you were getting 8, 9% on staking your SOL. So it's already decreased today to probably around 6 and 6.5%. And it was always anticipated that the reward for stakers, and it's just as a reminder, stakers, that activity of staking your tokens is what helps secure the network, and having a secure network is in everyone's benefit. Then what was imagined is that over time, usage of the network would translate into fee generation, both a combination of base fee, which is a fixed amount attached to every transaction, as well as priority fees, where priority fees are typically generated off of trading activity where users or traders are competing for best price execution. And so I think the vision over time has always been that base fee, priority fee, and potentially other sources of protocol revenue would step in the form of block rewards and balance out what folks have relied upon up until now to sort of solve the cold start problem, which is inflation and staking rewards.
I polled my audience. People just want you to give a price estimate for Solana. I'm not going to ask you that, but what I will ask you is what ultimately will drive demand for Solana. Basically, your future, your future vision for Solana. I think you've talked about the fact that it's going to attract institutional capital. It'll improve on network infrastructure. It's not just going to be like Bitcoin, which is a store of value. So ultimately, in 5-10 years, what will be the dominant drivers and use cases of Solana such that it will potentially move the price?
Yeah. The number one network effect, the strongest network effect that you could ever have is around money. And I think over the last 10, 15 years, looking at how tech has evolved I think it's proven without a doubt the strength of network effects around something as verticalized as e-commerce, as ride sharing. And the biggest network effect really of all is around money. That's what we see with the US dollar and its usage around the world and the difficulty of displacing the US dollar. That's what we're also starting to see around Bitcoin and the inability to dislodge Bitcoin from being digital gold, or for that matter, just regular gold. Why is gold gold? It's a social construct. It's because everyone else thinks that gold is going to be valuable and has some vestigial use for utility, both in an industrial and also a decorative setting. And so what I think you're going to see is that's the asset world. On the infrastructure world, you're going to see that same network effect building around these technology platforms for the movement of money and assets. And I think you already see that today, where that's the reason why Solana is the most used chain out of the entire industry, more than all of the other chains combined, and then multiplied by 2 to 3. And as you see that usage and adoption, both in number of users, number of wallets, number of transactions, number of fee-paying transactions, number of priority fee-paying transactions, what you see is issuers look at this and they see distribution, right? They see there are 100 million potential wallets who are going to buy my asset, and they just do the quick math. I distribute that asset on this infrastructure, 25 bips management fee. That's a simple way to think about it. Application developers also look at Solana as not just a protocol revenue chain, but the application revenue chain. If you look at where application revenue has been the highest across the entire industry in 2025, year to date, that is Solana. And that's powerful because what builds these open source ecosystems is the builder and the developer community that wants to come create applications for people to use to increase the overall utility of the ecosystem. And of course, they are entrepreneurs, they are capitalists, they're not doing that for free. And what we see is application builders make more money on Solana than anywhere else. So what you've got this flywheel of the network continuing to be the most scalable, most performant, and ever more so network that can support all financial applications and the existence of all assets in a single market. So you already have the technology that can support that network effect. You've got the best place for developers to be building, and you've also got the best place for asset distributors to be issuing. And that is, those three components together are going to be creating a network effect that we already see as being difficult to compete with. And that is something that is really just going to extend its reach over time as well.
The future of Solana being where it needs to be. What are some of the technological innovations that needs to happen for it to become the fastest, most scalable blockchain in the world? You've already mentioned a few of them, but technically speaking, what needs to improve from now on?
Sure. There's two things I would point out. We already talked about Alpenglow and how that's anticipated to bring block times down to 150 milliseconds. One of the ways that's happening is there's a couple of things happening under the hood, but probably the headline one of those is multiple concurrent leaders. So what you have right now is you've got one leader assembling every block within Solana. And one of the original innovations of Solana is something called proof of history that allowed parallel execution. And this is one way you could think about multiple concurrent leaders as a way of really supercharging that. And that's one of the core ways that block times are being brought down pretty substantially, 400 to 150 milliseconds. Another one is, this has always been about pushing network performance to the edge of physics, with the one constraint you accept being that, look, it's a decentralized network, so you never know where the leader or the leaders are going to be around the world. So the one thing that you're optimizing for is the permissionless nature of the network, and the fact that anyone can join and leave the network, and that leader could be really anywhere around the world, right? So what that means is that some of the physical limitations now come down to physically the fiber and how quickly you can transmit information really around the world, right? If server 1 is in Tokyo, server 2 is Chicago, that's going to be a different latency a profile than Tokyo to Hong Kong, right? And so the second thing I'd want to point out is recently launched Double Zero. So Double Zero is creating fiber network around the world, making that available to blockchains to make this dedicated fiber for transmitting blockchain transactions around the world. And instead of today, everyone is riding on publicly available fiber. But really, if you look at the most performant centralized computing networks, whether that's for finance or whether that is for consumer applications, social applications, or otherwise, typically those are all riding on private fiber. And this is a blockchain take on making that available for blockchain transactions. So that's on the reducing latency side.
Oh, sorry. I was going to say some critics may point to the fact that perhaps decentralization and speed are opposing philosophies. Is there any sort of contradiction here? In other words, are you sacrificing decentralization for higher speeds?
I think that decentralization is not a single monolithic kind of definition. I think there are some people that would say decentralization is measured in the total quantity of nodes that you have. And so therefore, anything less than being able to run a light client on your Motorola flip phone, anything less than that is less than maximal decentralization. That's decentralization maxi, kind of one end of the spectrum. And then others see decentralization as a lot of people look at the Nakamoto coefficient, which is a measure of how many nodes would have to be corrupted at the same time in order to exceed 33% of the network and corrupt ledger history, right? And so I think that would be the range of different ways that people measure decentralization. And so, up to different people to pick where what they think is the true definition, the meaningful definition of decentralization. And I think actually, if you take a look at the Nakamoto coefficient, which is a very pragmatic definition of decentralization, then Solana has been near or at the top of the major proof of stake blockchains, certainly over the last 4 years that I've been involved.
Okay, excellent. Thank you very much, Lily. Appreciate your time, and I appreciate your
thank you
education. Where can we learn more about the Solana Foundation in the meantime?
Sure, you can always follow Twitter handle @Solana. That's a simple one. And happy to have folks follow myself as well. I'm @CA_LilyLu.
Okay, good. We'll put the links down below, so make sure to follow Lily and the Solana Foundation there. Thank you again. We'll speak again soon. Take care for now.
Thanks, David.
Thank you for watching. Don't forget to like and subscribe.